Welcome to the Bogleheads Chapter Series. This episode was hosted by the Metro Boston Bogleheads Chapter and recorded September 17, 2022. It features Paul Merriman from the Merriman Financial Education Foundation discussing the 10 most important lessons they have learned over the past decade. Bogleheads are investors who follow John Bogle's philosophy for attaining financial independence. This recording is for informational purposes only and should not be construed as personalized investment advice.
Okay, it's 12 o'clock, so we're going to go ahead and get started. I wanted to welcome everyone to the Boston Bogleheads chapter meeting. I'm Therese Reynolds, the Boston chapter coordinator. And a few things before we begin today's meeting. The presentation will be recorded, including the questions and answers. If you don't want to be seen on the recording, you can turn off your video. The chat will be saved, but all names will be removed. The recording will be saved on the Boglehead chapter series on YouTube, and I will also provide a link to the recording when it's available, as well as a copy of today's presentation. And you'll have an opportunity to ask Paul questions after his presentation. Please put your questions in the chat or raise your hand. And just a few Zoom tips before we start. Please mute yourself during the presentation and stay muted unless you're speaking. On a laptop, you can raise and lower your hand by clicking on the reactions button at the bottom of the screen and then click to raise the hand icon. And you can change your name by right-clicking on your photo and then selecting rename. And you can keep your video off during the presentation, but if you ask a question at the end, it would be nice to have your video on. All right, I'm going to go ahead and start. I'm very pleased to welcome Paul Merriman today, and a little background on Paul. In 1983, Paul founded Merriman Wealth Management. After Paul sold his firm and retired in 2012, he established a financial education foundation. And the mission of the foundation is the Merriman Financial Education Foundation believes knowledge is power and is dedicated to providing comprehensive financial education to investors at all stages of life, with information and tools to make informed decisions in their own best interest and successfully implement the retirement savings program. In the 10 years since Paul founded the foundation, he and his team have produced 5 books, and all but one are available at no cost through his website, and more than 700 articles, podcasts, and videos. His website also includes recommended mutual funds and best-in-class ETF portfolios at Vanguard, Fidelity, and Schwab. And I've been listening to Paul's podcast for over 3 years while driving to work each day. And I've learned so much from him about investment strategies and how to invest more money with less risk. And I'm also so impressed with the time Paul gives to educate investors of all ages with free information and tools to successfully implement the retirement savings programs. And when I contacted him to talk about our group, he not only said yes, but he was so enthusiastic and excited to do it. And we're really lucky to have him here today. The Merriman Financial Education Foundation is celebrating their 10-year anniversary this year. So Paul decided to take the opportunity to discuss the 10 most important new lessons they've learned over the past 10 years. And again, after Paul's presentation, we'll open it up for questions. And I will now turn it over to.
Thank you, Therese, and thank you for all that you've done to make this possible. I am excited. I've never made this presentation before, and as I thought about the 10 years that we've been working to help investors, I realized there's probably some things that are unique to our teaching. And so I thought I'd focus on the things that have come out of our foundation that we think are some of the best work in terms of helping investors understand the process of investing. And I do want to get my pointer up here for one second. You've already read the mission statement, Therese. So let me just add something about our mission and what we're trying to do. It's different, I think, from any other organization that I know. Yes, I was an investment advisor and worked with many investment advisors to help people do the actual, not only the planning, but the implementation and the managing of the money. And so we had to learn a lot about investing as a part of that process. And my goal is this: I am now here to help do-it-yourself investors do better. I mean, that's the goal. And that means, from my viewpoint, that when you are a do-it-yourself investor, it means you need now to be the professional. You need to know the information that the people that worked with me needed to know to give advice to others. Because in your case, you have one client, theoretically, maybe some kids and relatives, but basically you are the advisor to the most important investor on earth. And so I want to make sure that you have all of the data, all of the studies. And when I say all, I don't mean every study that was ever done, but the information that if you were an advisor to others, you would want to have that available to help them. So let me speak with you, share with you as a teacher. I'm not an investment advisor. I don't give anybody individual personal advice except very close friends. So I am a teacher, and I know this old saying about when the student is ready, the teacher will appear. Well, I'm hoping that today, for at least a handful of you, there's an opportunity to do some serious teaching here. And I thought it would only be fair if I share with you some of the major teachers in my life, Dr. Fama and Dr. French from the dimensional funds. And actually, they're academics who were the ones who developed the early research on factor investing, the premium for small, the premium for value, the premiums that now people understand commonly in building a portfolio to take advantage of not just being in the market, but what part of the market. And then, of course, I mean, it's not just because I'm here with the Bogleheads I say this, but John Bogle, he was one of the best teachers, and yet my class with him was only 90 minutes in his office. But that 90 minutes truly changed my life. And then Jason Zweig, he writes for the Wall Street Journal. I hope, if you haven't read Your Money and Your Brain, that you will, because it is a wonderful paperback book, costs next to nothing. And I think you will learn about why it appears so many people are just a little bit crazy when it comes to money topics. And then one of the best in the industry as a teacher is Larry Swedroe. I think he's written 15, 16 books, and every one of them is in its own way a classic. And if you want to be good to yourself, in fact, I reached for this one. It's Your Complete Guide to a Successful and Secure Retirement. It is just terrific. And by the way, I am not a financial planner. I am not an estate planner. I am not a tax expert. I am not a CFP. I'm a guy that likes the process of investing. And then two other folks, I know you heard of one of them, many of you did. That's Chris Pedersen. Chris Pedersen has been an amazing teacher for me. He is our director of research. Daryl Balls is our director of analytics. You're going to see some of his work today. He has figured out such clever ways to teach people about how investing really works. And this is not my creation. This is his creation, and Chris has done what he's done. They both are working for our foundation without pay. And the final person, I suspect nobody there knows her because Atwood happens to be her maiden name. Sarah Louise Atwood is my mother, and there are two things she taught me. She taught me about the respect for others, and she taught me that it's my responsibility to serve others. And I am so happy she taught me that, because without her, I probably would not be here today. So I'm going to focus on a handful of lessons. These lessons, I think, are some of the most important, and yet not all of them are taught or not taught the way I would like to see them taught. And lesson number 1 is about the importance of an extra 1/2 of 1%. People throw returns around, and they oftentimes don't realize that just small changes in what we do with a portfolio could lead to little additional returns. And pretty soon you got an extra 1/2 of 1%. And what does an extra 1/2 of 1% potentially lead to? Early retirement for some, having more to spend in retirement for some, leaving more to others at the end of your life. In my case, my IRA all goes to the foundation at my passing. And so to the extent that I can, I want that to be as big as it possibly can to help, to be there to help others. But for every extra 1/2 of 1%, I can make the case that whether you're a first-time investor or you're a first-time retiree, it can be a $1 million payoff. Let me just show you quickly. Let's just assume we have 2 investors. One of those investors, and I want to get my pointer here for me if I can, just 1 second, please. Well, I guess I'm not going to get my pointer right now, but one of these investors makes 8% during the accumulation period, and then in retirement makes 6%, and from that 6%, they take 4% each year to live on. The second investor makes an extra 1/2 of 1%. Now, I'm sure you have lots of ideas how one might make more money. But if there is an extra 0.5%, that means 8.5% during the accumulation period and 6.5% during the distribution period. And we make the assumption that $5,000 a year was invested, and they started at age 21, and they retired 46 years later, and they lived in retirement to enjoy the money to live on. So what is the long-term impact on that? Well, first of all, there was an investment in both cases of $230,000. In the case of the first person, at retirement, they had about $2.3 million. They took withdrawals of 4%. And by the way, that means a little money is there to build and become of greater value in the future. But they took withdrawals of about $3.5 million. They left $3.8 million. So from my viewpoint, when people ask me how I've done with my investments, I'm not going to really know how I did until I die, because at that point, they could figure out how much did he take out to live on and how much did he leave to others. And that is the real return on that $230,000, which, if you add those two together, totals over $7 million. But the person who figured out a way to earn an extra 0.5 of 1%, instead of having $7.4 million, they have $9.6 million. They have $2.3 million more because somehow, they found an extra 0.5 of 1%. And so when we wrote the book, we're talking millions, Rich Buck and I, 12 Simple Ways to Supercharge Your Retirement. It was really about looking for those 1/2 of 1% opportunities. And they're legitimate, which in theory, if there are 12 of them, and in every case we can figure out a way when you come to a fork in the road to do better with one fork than the other, you could in each case have an extra $1 million. And by the way, I'm hoping that you will take the free copy of the book. I am hoping you will not go to Amazon and pay for the book. I am hoping you will take the free audio that you can get. And the reason I want you to get it free is because my hope is you will pass it on to family members. All you have to do is send them the link and they're in. And my goal is, if I can last 10 more years with this foundation, that we're going to get 1 million books out to people. Now, you all can get a copy of the book. It'll take you a couple of hours to read theoretically, but I can give you in just a few minutes what you're going to learn. Where can you get an extra 0.5%? And it turns out that the first one, choosing stocks over bonds for the long term, bonds compound at around 5 or less historically, stocks 10 and more. as a group, depending what group you look at, and you'll see that in a second, there is a 5% difference right there. If in fact a 0.5% will add $1 million, think what 10 0.5% or 5% would mean over a lifetime. It's huge. And yet a lot of young people refuse to go into the stock market because it's so risky. And choosing mutual funds over individual stocks, young investors think they're going to make the most money if they get on some hot horse and ride it. And yet every study I've seen says the probabilities over time are going to be greater with a diversified portfolio than a non-diversified portfolio. And what do bogleheads know above all? That lower expenses are likely to lead to higher returns. That is true. That is absolutely true. That doesn't mean because you could get a bond fund with 0.1% fee compared to a stock fund of 0.2% that you should be in the bond fund. No, first it's the asset class, then it is the expense. But there's no question, based on what we know at Morningstar, that an extra 0.5% is just sitting there for a lot of people who are in mutual funds that are charging even more than 1%. One thing a lot of people don't know is that when you're in a taxable account, Morningstar actually keeps track of the tax efficiency of funds. Some funds have very high tax efficiency. Some funds have very low tax efficiency. When you look at the difference between index and actively managed funds, and you look at the after-tax return, there's typically about 1% lost to taxes in an actively managed fund. And so that is just one more advantage for the index fund over actively managed. And of course, we want young people to take advantage of tax-favored accounts. I'm going to be talking in a few minutes about a young investor, 17 years of age, who is making that choice to do tax-favored investing. And I think you're going to love the outcome, potential outcome, and maybe find someone in your family to do the similar thing. Adding small cap and value asset classes to a portfolio, another way historically of adding a 0.5% or more. Now, these decisions here are not exactly about getting something that you can compare so easily, but I can tell you that choosing saving over spending is one of the biggest decisions we make. Warren Buffett says, don't save what's left over after spending, spend what's left over after saving. Pay yourself first, and start it early. This 17-year-old young lady who's starting at 17 instead of waiting and until she's got a full-time job, it's going to make a huge difference. In fact, most people who see this today are not going to believe it. And then choosing buy and hold over market timing. Almost everybody says, oh, don't market time. Market timing doesn't work. You hear that all the time. And yet, what do most people do? Yeah, most people do market timing. If they think interest rates are going up, they want to get out of bonds. If they think international is going to be better than U.S., they want to get out of U.S. and have it in international. They want to move things around. That all has to do with market timing. Now, you can do it technically, mechanically, or you can think it all out, but it doesn't change the fact that you're taking steps to try to perform better. All of the evidence is it does not help. Lesson number 2. I think this is huge. How to compare equity asset class returns. There's not enough information as far as I'm concerned. But what Darrell Balls has done to help us, first, he gives us this information. This is pretty simple information, but it's a good start about equity returns. Here's the S&P 500 large cap blend here in the first column. Second column is large cap value, small cap blend, then small cap value. And over the last 94 years, those returns ranged from 10.2 up to 13.4%. Looking for a 0.5%? Sounds like there's some in there. But these are very, very high-risk investments on a short-term basis. This is what scares so many young people away. I might lose a lot of money. You will lose a lot of money. We just don't know when. But we know, looking backwards, that the best year that the S&P 500 ever had was up 54%. The worst calendar year was down 43%. And each of these asset classes, you can see there, and here's, by the way, the gold ring of asset classes is U.S. small cap value, because that compound rate of return is about 3% more than the S&P 500. That's a lot. And the risks on the downside are not that much higher when you think about the potential return. Now, I'm just going to give you a little taste right here, but notice to the far right, we have these combinations of these 4 different asset classes. And if you put 25% in each of those 4, the compound rate of return over the last 94 years has been 11.9%. And the returns against on the upside and the downside, well, on the upside, they're much better. On the downside, they're not that much worse. More on that later. When we go out, and this is the lesson young people need to understand, when we go out and look at 15-year periods, all of a sudden, you're not looking at a plus 50 and a minus 40. You're looking at the best 15-year compound rate of return was 18.9 with the S&P 500, and the worst was a little better than break even. And the other ones were not that different, by the way. Large cap value was a little loss. Small cap blend was a better profit, 1.6% a year. Small cap value, a loss of 1.9%. Now that's 1.9% for 15 years. So that's not a small loss, but that's the compound rate of return. And here again, we have these combinations of asset classes. Look over here. I love this one. I just love it. The 2-fund strategy, half in S&P 500, half in small cap value. Compound rate of return, the best was 21.6%. The worst was virtually the same as the worst for the S&P 500. But the best information is the longer term information, because that difference between the best and the worst continues to shrink. That's an important thing for young investors in particular to understand, that your risk in reality goes down a lot. And the best 40-year return was a gain of 12.5%. The worst was a gain of 8.9%. So the worst 40 years was still profitable. And by the way, if you inflation adjust those returns for those periods, there was only about a 1% difference. So these are nominal returns without adjustment for inflation. And notice the average 40-year return of the S&P 500 happens to be the return of the last 52 years, 11%. Small cap value was 16.2 average. Now that didn't, the last 52 years didn't produce 16, but it produced about 14. And large cap value and small cap blend are in between. And again, when you look at these combinations, you go from 11 with the S&P 500 to 13.7 with the combination of the 4 asset classes. And look, the worst 40 years was 10.8, about 2% better than the worst 40 years for the S&P 500. I'm thinking that 4-fund strategy is worth at least taking a look and finding out more about that risk and return. Now here's, and I mentioned this before, short-term returns are random. They're all over the place. Now, when you ask people, well, what do you think the market will do next year? Invariably, most people will say, probably up about 10%. Why do they say that? Because that's the compound rate of return, basically, for the long term. But the reality is it's going to be all over the place. And I want some way, some tool, some information that would help me and help others understand that randomness. And here it is. Daryl Balls, our director of analytics, built this table. I just love this table because I can look at this from 30,000 feet. I realize that these different colors, green is the S&P 500, The kind of yellowish tan is the large cap value. The reddish color is small cap blend. The electric blue is small cap value. And then we have that 4-fund combo that's purple. But when I look just at the green, because green is what I know, the S&P 500. By the way, I also know that the S&P 500, that expected return is lower because it's of higher quality. And if it is lower because if it's of higher quality, that means that it's probably not going to be number one very often. Well, it is number one often, regardless of what the long-term return is. But we never know. I mean, there was a period here from 1940 to 1945 where it's green every year at the bottom for 6 years. But then if we fast forward to 2014 here through 2019, in all but 1 year, it was at the top of the pile. And of course, anytime it's at the top of the pile, people say it's the only place to be. You see, small cap value is dead. The premium for small cap value is no longer available because the S&P 500 recently has been doing well. That is one of the biggest traps. It makes you believe that there is something, a trend that is going to last longer than it is likely to last. So I just want to use this to show how this stuff just moves around from year to year. And those who think they're going to market time or find some sort of a pattern here, and I'll talk about the pattern that I get here that just knocks my socks off. But as far as a pattern to know where you should be, green, blue, brown, red, whatever, it isn't here. Asset classes drive returns, lesson 4. If you look at all those years, you will see, if you look at 1 year at a time, that it is the asset classes that make you or lose you money, not the stock picking, not the market timing. And let me just take you through 4 years, just 4 years of that quilt chart that Daryl put together. 97 small cap value up 39%. Large cap value up 38.4. Hey, looks to me like it was a year that value was kind of king of the hill or queen of the hill because it was the two value funds sitting at the top there of performance. Down here at the bottom, these were not horrible years. But remember, when you see the S&P 500, I want you to think growth. It is not a value index. Yes, it has some value in it, but it is cap weighted, and those returns are driven by the most growth-oriented companies. And the same is true with small cap blend. You've got the power of small growth. So that was not the place to be. And by the way, when I say that, understand there's no risk in the past. I always know we always know what we should have done. And all we have to do is look at the past and see what we should have done. Well, in 1997, we should have been in value. But what good did that do us for 98? Because in 98, it wasn't small. It wasn't value or growth that drove the positive returns. It was large blend and large value that created the positive returns. Now, true, yes, large growth did better than large value. But notice the small cap indexes actually lost money. So if you looked at the list of the best performing funds for 1998, guess what? They are going to be large cap kind of growth oriented funds. The worst performers are going to be in the small cap. And yet these people who were in the large cap growth or blend, they'd like to think that reason that they were so good was because they picked the right stocks. No, they were in the right asset class. 1999, all of a sudden, it looks like growth was the winner because small cap blend and large cap blend, never driven by growth mostly, did well compared to the value. Yeah, value was up, but about a third of what the growth was up. And finally, in our fourth year, here we see it again, values leading the pack. In fact, small cap value up 20.5 and the S&P 500 down 9.1. And you could ask yourself, are they in the same market? How can that be? But if you look back at that 1928 to 2019 quilt chart that Daryl put together, you will see that is not an unusual outcome. In fact, between the S&P 500 and the small cap value, the average difference in return per year is about 15%. Lesson number 5, diversification of asset classes is $1 million decision. See, a lot of people have told, all you really need is the total market index. All you really need, Warren Buffett says, is the S&P 500, because those are really good companies and they drive a good long-term return. But they totally ignore the idea of diversification. Well, they'll say, of course, there's diversification in the S&P 500. There's 500 companies, but they are 500 companies that are basically in the same asset class. And sometimes those asset classes fall apart for long periods of time. But I want you to see the impact of diversification. And you can say that I am optimizing or data mining, and I don't think I am at all. Because I'm looking at this whole 1928 to 2019 period, and I'm seeing the green and the blue and all these colors all over the place. But when I look at the diversified portfolio of all 4 of those asset classes, I see a lower risk investment. I see a strategy that is likely to help me stay the course when there are times that people want to bail out of other investments. And I'll show that to you in a few minutes with the S&P 500 from 2000 to 2009. You'll see it in action. It fell apart. Well, yeah, it fell apart after it was up over 17% for 25 years, from 1975 to 99. So it's not like it's a miracle that it was out of sorts and out of favor for the decade of 2000 through 2009. But a diversified portfolio of asset classes. What's the key? Lesson number 6. Now, I've already given it to you, but I'm going to add something to it that's a little uncomfortable. But there's no question from looking backwards, if we want to use the past as any indication of the future, that small cap value is the best of these major asset classes for the long term. And the academics would say, well, it's easy to understand why. Because you